Big changes are afoot for the way pensions work in the UK, so with no more ado, I want to devote 3 videos to the topic of pensions. How's it going to work? The 3 videos coming up. This one is going to deal with the looming retirement crisis. And if you don't think there is a looming retirement crisis, I'm about to correct you on that one. Number 2, how pensions work. All right, what are the bare bones of pensions as we currently know and love them? And thirdly, what's all changing April 2015? That will be a summary, no more than that, in under 10 minutes of the big changes coming down the line. Some of the biggest changes we've ever seen in pension rules and legislation. So, what is the looming retirement crisis? Well, in a nutshell, it's this. Unfortunately, I'm not a baby boomer, and my children won't be, and my grandchildren won't be. My parents are, and they've enjoyed some unique conditions, the like of which we're not going to see again, certainly not in my lifetime. Rising house prices several times over, as predominantly central banks like the Bank of England have slashed interest rates. Not surprisingly, asset prices have risen in response. Interest rates, as I'll mention in a moment, can now only go one way, and it's not good news for people thinking, brilliant, everything I ever wanted in life will be funded by buying property. Not true anymore. Defined benefit pensions. Now, that is the idea that the state or a company guarantee the amount of pension income you get when you retire. So, as one of my father's friends said, I don't need to worry. Spend everything I earn until I retire. As long as I do my 40 years, I get my boilerplated, lovely pension. Those are dying out. Companies have cut them back, and the state is also looking at ways to cut them back for reasons I'll discuss in the next video. Decent annuity rates. All right, now, when my father retired, going back quite a few years now, annuity rates were a lot higher than they are now. And that meant if you had a money purchase pension, as they call it, a lump sum of money, you could hand it over to an insurance company and actually get quite a decent income in return. Well, anyone who's tried to pull that trick recently will realise that annuity rates have rarely been lower. And finally, a generous welfare state. All right, as my parents grew up and matured, the welfare state was basically expanding. These days, the government's under pressure to do the exact reverse where possible. So who knows where pensions will be when I get to retirement, even the state one that a lot of people take for granted. So there it is. Those days are gone. An era of record low interest rates, cheap mortgages has to come to an end. The only question is when. Final salary pension schemes being scaled back or shut. States under pressure to reduce spending in all directions, and pensions are not sacrosanct, by the way. And that means, or can lead to the conclusion that parents are increasingly likely to be supporting their children in the future as their children are to be supporting them. So far, not a pretty picture. Right, just a word about the interest rate set by the central bank, the Bank of England. It's never been lower. All right, just to reiterate a point I made back there. It's never been lower. It's sitting around 0.5%, has been for some time. Can't go much lower than that. All right, it's been supplemented with something called quantitative easing that I'll deal with in other videos. And the point is this. Mortgage costs can only go one way, and it's up, for anyone wondering. All right, because that rate is going to have to lift at some point. Maybe not imminently, but it's going to have to go up at some point. Same for the American rate, and so on. However, the good news, the one beacon of hope for people planning their retirement is that will probably take annuity rates up with it. In the next video, I'll explain what annuities actually are, but it does mean there are better deals potentially coming down the line for people swapping the lump sum they have for an annual income, as opposed to spending it on a big party. More about that in the 3rd video in this series. Just note that, keep that thought in the back of your mind. Now, why worry? Well, HSBC, big credible bank, have estimated the average pension pot at the moment is a little under £37,000. That's not a lot when what you're trying to do is buy yourself an income. Because remember, you're stopped work, no one will be paying you a salary, you need an income. That turns into about £1,350 at current annuity rates. Hardly a fortune. And the government have actually done an estimate of what you need to live on to live a kind of reasonable retirement, and they reckon, you can argue with the number, it's more like £16,200. And you might sit there and think, maybe that's your annual sort of gross income from whatever it is that's paying you in retirement, this lump sum. So there's quite a gap. And that's where the looming pension crisis comes from. A lot of people don't realise how big the gap is, and they're not taking steps to address it. Okay, now for what I call some dire demographics. All right, this is a problem that's going to get worse and worse because, just a snapshot, the percentage of people aged over 65, right now, 17%. Roll forward 50 years, 24%. That's a quarter of the existing population. Percentage of people aged over 85, now girls being born today are predicted on average to live to 100 plus. Currently, 2%, that may not look high in absolute terms, is going to triple to 6% in just 50 years, bear in mind. Long-term care and pensioner benefits, therefore, as a percentage of UK GDP, says the Policy Exchange, help to save study, 8.4% at the moment, 12.4% in 50 years' time, putting that added pressure on the state to cut back, cut back, cut back. So anyone looking, sitting there thinking it's all right, the government will kind of take care of me, no, they probably won't. And when we look at the level of state pensions in the next video, you'll see that for most people that's just not going to be enough. Now, early conclusions then, the bad news. Most young people will be working longer. I mean, what are the solutions here? All right, one is to work longer, go on till 70 plus will become common in the future, I think, provided you can get work, provided you're healthy, provided you can get it in the right place. And we need to save harder for retirement than possibly our parents did, sitting there with those nice defined benefit pensions. So you need all the help you can get. Now, 3 things that people can do for themselves, and then something that families can do for them. So the 3 things they can do for themselves: start saving earlier, I'll illustrate that in a moment, harness the long-term power of compounding, and minimise tax. No point in paying tax along the way if you don't have to. Take the tax breaks that are available, and I'll point out in the next video in more detail. Those are 3 things that younger people, and I put myself into that category, by the way, in my 40s, I'm not talking about somebody who's even sort of 25, can do for themselves. And then we'll look at what families can do for them. Now, starting early, let me just make the point here. Starting early or starting earlier, look at what 10 years does to your pension pot. So let's take someone who's aged 25 now on a salary of £30,000, all right? They make a contribution one way or another of 8% of their salary into their pension, just 8%. Now that could be coming from them, could be coming from their employer, could be a mix of the two, and they commit to beef that up at 2% every year. So they'll increase that with some kind of estimate of inflation every year. Annual real growth rate on what they put into the pot, invest into the pension, is 5%. Not guaranteed, but let's assume 5%. Once they get to 65, how much will they have? Well, using a simple sort of compounding calculator, if you like, the answer is £400,000. They'll have saved £400,000 off their own VAT. Take out a tax-free lump sum, because you can take a quarter of that as a tax-free lump sum. That's 100 gone. Turn the rest into an income by handing it over to a life assurance company, saying, give me an annuity, let's say. You'd have around £16,500. You'd be quite close to the government number, a little bit over. So buy yourself an extra coffee type thing. All right, slightly over what the government recommends you should have in retirement. Now, there is a state pension on top of that, potentially, but you've done most of the legwork yourself. Now, let's assume you started from the age of 35, not 25, 10 years later. Same facts, I'll run through them fairly quickly. Salary 30,000, pension contribution 8, rising at 2. Exactly the same left to right. Annual real growth, assume, not guaranteed, of course, 5%. Not an unrealistic annual real growth rate, based on the past. The pot, age 65, you'll have generated 206,000. Take out your tax-free lump sum, should you wish to, put the rest into an annuity, and roughly you are 50% of the level you would have been on the left-hand side. So that 10 years has cut your annual income roughly in half. Take my point about what young people can do for themselves in terms of starting early. But families can help too, all right, if they get going. Grandparents, for example, can help their grandchildren. Parents can help their children. Now, none of these figures are guaranteed. So if you put £3,600 in once on behalf of someone being born now, you get 5%, not guaranteed, just making it up for an example, but 5% real growth rate every year, and you allow that to compound for 70 years on their behalf. So obviously they can't do it, they've just been born. In goes the 3,600, some of it comes from the government, as I mentioned in a moment, grows at 5% annually over 70 years. That could turn into a real, inflation-adjusted, £110,000. That's £110,000 of real purchasing power when they're 70, and that is quite a leg up on the pensions ladder. And bear in mind that under current rules, 20% of the amount you put in can come from the government, reducing the amount that you have to contribute to more like £2,800. Okay? Just food for thought. In the next video, how pensions currently work.